Hey everyone, Douglas here, and welcome back to the MMT Macro Trader in this market recap for Friday, June 23rd, 2023. And after a rip-roaring few weeks there, we finally saw a week of selling in the markets. S&P down just over 2.5% from that peak that we saw last week. Everything is playing out just as expected during the last update. Here on the channel, we had mentioned that we were going into OPEX. There's going to be a window of opportunity for volatility to kind of kick up here. Everything is playing out to a T as we were expecting. Getting a little breather here in this rally, but the data continues to flow in very bullish. We're going to take a look at the chart on the screen in just a second. Before we do, get subscribed, hit that notification bell, turn that thing on so you won't miss an update going forward. The information I'm bringing you is valuable. You don't want to wait on the stuff I'm bringing you, so get that notification bell turned on. Hit the like button too if you end up finding this update helpful. But without any further ado, let's go ahead, get into the data, talk about markets. Again, we were expecting this week to be a bit of a chop. That's exactly what we got so far, and especially if you're a Patreon patron and you're getting the weekly updates, you know that we are right in line with where we would expect. So far, nothing unusual. And the underlying structural flows, the key thing to understanding the direction of where markets are headed, continue to show up green. We are seeing that across the board. What I have in front of you is the margin debt acceleration that I measure. And this is, unfortunately, with downside, I'll give you the downside, it does come out a little late. This data lags by a few weeks after it's actually collected to when it's published. It's the one downside. But the upside is it is a tremendous tool for understanding where markets are headed, and particularly for understanding what the credit cycle is looking like and what the appetite is in that credit cycle for speculation. And that's exactly what we're seeing. We're seeing a very strong acceleration of margin debt. And as you can see, overlaid with the margin debt in the green color in the red color is the green color being the percent change, the year-over-year change of the S&P 500. When you lay these over one another, you can see there is a very strong correlation. The work, like people of Steve Keen have done, have demonstrated, showed mathematically that it's the credit cycle, it is the private debt cycle that fuels the asset moves. And so when we see acceleration in margin debt, that gives us that indication to know, that gives us that clue that we are starting to see an upswing in the acceleration of the credit cycle, particularly the acceleration of the credit cycle that is most closely related with risk assets. Obviously, margin debt, you're buying shares, you're buying assets on margin. And that is why I think we're seeing, again, just this culmination, the fiscal flows, we're seeing bank flows, we're seeing everything at every turn. We're seeing this economy be stronger than expected, all off the back of this higher interest rate, the higher interest income, stuff we've been talking about for weeks now, playing out, and now we're seeing it positively impacting, or I should say bullishly impacting the credit cycle as well. So we're starting to see a reacceleration. So it's no surprise here that we're seeing. I think I saw Bitcoin hit a new high for this year. Right, a lot of stocks that everyone were saying were dead are continuing to fly higher, and we're starting to see kind of that speculative move higher on the back of the margin debt acceleration. So very bullish news here. The bears, look, if you're a bear, a market bear, not a literal bear, but if you're a bear, you're going to be in rough shape here. I mean, you're really fighting against some strong underlying flows going forward. Now, look, I know we had a pause this week, all within what we were expecting, absolutely anticipated. This is what happens after big moves. You get a bit of a breather. That breather usually happens at OPEX. We have tools over at the Patreon page. If you're a sub there, you know exactly what I'm talking about. We have tools to understand where these ranges will likely show up. So make sure you check those out. In fact, last night, we just published for the first time. We're going to continue to build it. It's a work in progress. We just published our daily dashboard up on the Patreon page, and we're going to get that fully operational. But it's going to have all the tools that you need to understand where the flows are, to also understand where the short-term ranges might be, to make the best decisions you can when making your trades. But that is up there. So we were tracking that. Now, here's the thing. I recently posted this chart on Twitter. And what I got in response, and this just shows this shows how naive, how almost uneducated so many traders are out there. Because what do I get back when I get shown this chart? But I get back someone showing me this chart, which is the margin debt and the S&P overlaid. And it's very clear, the point being made, it's very clear. Margin debt is barely taken off. In fact, we're still very depressed. And this is going to be the little lesson that we're going to take here, because one of the things that Steve Keen and the work that he's done and the work that the systems dynamic people have done and the work that those in the heterodox school have done, those who understand what endogenous money is and how it operates, one of the things they told us, one of the things they taught us is that it's not about the underlying stock of units. It's about the flow of whatever unit it is that you're measuring. And not only the flow, not just the first derivative, but the second derivative, right? Not only the velocity, but the change of that rate of change. And that's why we measure acceleration. And it's the acceleration function that's going to give us the leading indicator of where the underlying flow and ultimately where the underlying stock is going to go. So look, if someone shares with you some sort of chart that is a stock, so the difference between a stock and a flow, right? A stock is going to be the accumulation of whatever units came from the flow. So you have a bathtub, it has some sort of units of water, liters of water in it, 10 liters of water. And then the flow is going to be how much water per second, per whatever time measurement is coming in to that bathtub. That's going to be the flow. What you want to do is measure the flow. And even more importantly, not only do you want to measure the flow, if you want to see the direction of where that bathtub is ultimately going to head, you not only want to measure the flow, but you want to measure how fast is that flow accelerating. So if there's already a bit of a trickle, is someone turning that hose on even faster? And you'll measure that through the measurement of acceleration. And that's why the acceleration is really what you want to be looking at. Don't look at just the underlying stock. That's not going to tell you the whole picture. You're going to miss the fact that the cycle is starting to reverse and kick back higher. So look, if someone shows you just some chart that is some underlying stock, some underlying accumulation of some sort of units, however it might be, just politely tell them thanks, turn around and realize they don't know what they're talking about and they are not understanding the complex dynamics that are at play in the market. You have to look at the acceleration. So this is it. We are seeing accelerating flows across the landscape right here. Look, things might get a little choppy, continue to be a little choppy, maybe even into next week, but the flows are there. Without a doubt, this market is likely going higher, short of some major curveballs, and the major curveballs are now behind us. The debt ceiling, the bank blow up, all that's kind of behind us. We could have some pretty green grass in front of us, some opportunity for this market to run as we head into the summer. Even the fiscal drain, the June tax drain, that's behind us now. The spending is just going to keep on chugging forward because of these high interest rates. And from what I'm from what I'm seeing, from what Powell's saying, it's obvious they don't know what they're doing. They've said as much, but they still seem like that they want to continue to hike rates. They've said at least 2 more this year. And so we'll see if that continues to happen. That's just going to be more interest income to the private sector and continue to fuel these flows and fuel the acceleration in the flows that we continue to see across the macro landscape. So that is what I have for tonight's update. Like I said, you can find all of this. I have multiple updates each week over at my Patreon page, patreon.com/MMT Macro Trader. Like I said, that dashboard just went up last night. It's a work in progress. Bit in beta right now, but we got that posted for the highest tier there, the MMT Macro Trader tier. If you're an active trader, active investor, check it out. We're building a ton of cool tools that can allow you to analyze, understand the market through that lens of MMT. So you can really apply a framework of analysis that properly identifies what's doing what in the market. Unlike any other school of thought, MMT has the proper framework for analysis, and you can really get in front of the market, really understand where the market is headed with that analysis and research. Check that out. Patreon.com/MMT Macro Trader. That's all I have for tonight, though. Have a good weekend, everyone. Good trading, and we'll see you next time. Bye-bye.